still hold it today without being liable for any taxes, at least in most countries, unless you have to pay tax on unrealized gains. So let's just have a look at how gold has been performing versus government debt. So government debt has expanded massively over the decades. Since 1971, government debt, this is the USA, has increased from $389 billion to around $37 trillion today. That's nearly 100 times as much. And if you look at this chart, on the chart here, you can see the government debt, which is the green area chart at the bottom with a yellow line at the top. And you can see the government debt's been increasing fairly constantly year after year, sometimes a little bit faster, sometimes a bit slower, and it's starting to increase a little bit faster, and it's likely to accelerate away from here, mainly due to the fact that the interest burden.
A historic wealth transfer is starting right now. His charts show gold has just broken out of an 11-year base against the S&P 500. This signals massive money is beginning to flow from stocks into monetary metals. But the real story is silver. It's been artificially suppressed near $50 for 50 years. Oliver warns it's now set to throw a tantrum and could quadruple or quintuple to over $200 in just a couple of quarters, similar to how copper and lead exploded in 2007. This isn't a slow grind. He calls for a violent, rapid repricing, with a severe industrial supply deficit and Bitcoin crashing from $127,000. The conditions are set. The message is urgent. The shift is beginning, and silver is positioned to lead the charge, potentially making gold and silver miners the hottest assets of the decade. Subscribe to Fine Metals for latest market and finance information.
Is becoming more and more important, because back in 1971, which is here on the chart, in 1971 the debt-to-GDP ratio was only 25%. In other words, the total debt of the United States was 25% of their GDP. It was quite manageable. Today we're at around roughly 100% debt-to-GDP ratio. It's 4 times as much. In other words, compared to the economy, it's 4 times larger than it was in 1971. And the debt is as big as the entire economy itself. And the Congressional Budget Office predicts that debt-to-GDP ratio is going to continue to rise. And obviously it can't rise ad infinitum, because sooner or later something will go wrong. It always has in every country in the world where debt has become too burdensome. And on this chart, I'll just adjust it slightly there. On this chart, you can see the green area is the government debt, and the red line is the gold price. Both of these are on a logarithmic scale. So on the left-hand side, we've got the log scale for government debt, and on the right-hand side, we've got the gold price in dollars, also a log scale. And I've drawn a blue line, a straight line here, which roughly matches the past growth in government debt. If it were to continue at the same pace, and I stress that a lot of people think it will accelerate at a faster pace, me included, but if it continues at the same pace, we will see, in all probability, gold keeping pace with the rise in government debt. So what would that mean? It would mean by 2027, we might be looking at a gold price of 5,900. That's a best guess at it. It's not a prediction as such. By 2030, we might be looking at 7,800. By 2040, we might be looking at 18,900. That's what they've tended to do in the past, what the gold's tended to do in the past, and probably what it's going to do in the future. So one of the big problems with US government debt is the interest on that debt. Because the level of debt has risen as a percentage of GDP, so has the interest burden as a percentage of GDP, and we're in a higher interest rate environment than we've been in for the last 15 or 20 years. So currently, the interest being charged or having to be paid on national debt is increasing at quite a fast rate. So in 2021, the interest on the US national debt amounted to $352 billion. That's the figure from the Congressional Budget Office. To $352 billion in 21. 3 years later, in 2024, it was more than double at $881 billion. So it's gone from 352 to 881 billion in 3 years. And the interest burden is going to keep rising according to the Congressional Budget Office, their own numbers. It could be worse than they expect. The Congressional Budget Office is forecasting that the US government debt owned by the public will reach 120% of GDP within a decade, and it might go faster than that. And of course, we've seen on COMEX unusually large deliveries this year. We don't know who is taking delivery because that's secret stuff, but someone somewhere is taking a lot of gold. Now let's move to a more worrying aspect. I'm going to talk about the digital euro, which is about to arrive. The digital euro will be going live next year and will be full-blown by 2027. Now, we all know about some of the dangers of the digital euro, surveillance, controls, but this is not really what I'm talking about here. Obviously, this is a very sensitive matter, so I might use some cautious words like I think it may, but I think the reality is rather fearful. I rather fear the output. So let's start with the point that digital euros are not the same as the euros in your bank account. The central bank digital euros are a direct liability of the central bank. They're not the euros which have been created by your bank in a roundabout way and are a liability of your bank. Now, when your digital wallet arrives and you start using it, you'll find there's going to be a limit. The limit is expected to be around 3,000 euros. That's the maximum you'll be able to put into it. And there's a good reason for that. The rush into the digital euro, and it will probably be a rush because everyone will get their digital wallet and effectively at some point be told they've got no choice but to use digital euros. That rush into the digital euro will effectively be taking money out of the banks. Now, some studies are estimating that 10% of deposits could migrate into the digital euro. Now, I'm going to be frank, the banks can't handle a move of that size, especially not the smaller banks, which are dealing with retail customers who usually have very small balances. So if all these small balances move out into the digital wallet, as is likely, these smaller banks, I'm going to be polite and say they might face pressure. Well, face pressure, they're going to face more than pressure, insolvency, because they'll have a problem. They've lent money long-term on mortgages and car loans and things like that, and everyone wants their money back, and it's going to be very hard to lay their hands on money. So, but this now appears to be shifting. Some banks and some institutions have started to come out and say that portfolios should hold a little gold. And hats off to Morgan Stanley. Their chief investment officer favours a 60-20-20 portfolio strategy with gold as an inflation hedge. So basically, he's looking at moving from the traditional 60-40 approach in equities and bonds to a 60-20-20 approach where gold is one of those 20s and replaces half of the bonds. Another bank which has started to recommend gold, and there are a few others, is Standard Chartered. Ray Dalio, you may have seen, has come out and said that investors should have 15% of their portfolio in gold. Whatever the correct figure is, it's clear that the current level of between 0 and 2% is just too little. It's not going to move the needle at that level. You need at least 5%, and 15 or 20% would be a more sensible number. So even if a very small percentage of global assets, that's bonds and equities, rebalances into gold, and there's 300 trillion of these assets out there, it would absorb the entire year's mining supply. How much would have to deviate from those assets into gold? 0.1%, 0.17% would absorb the entirety of the gold mine's annual production. Put it another way, that's 1 part in 600, 1 in 600 of the amount of money in assets related to gold, related to stocks and bonds. So if institutional money starts to flow into these assets, the gold price will move very quickly. We've got central banks accumulating gold at a record pace. They're buying more than 1,000 tons a year for the last 3 years. And the high prices, the record prices, are just not deterring them. And let's face it, after all, they can print money as much as they like, so why would they care if the price is at an all-time record? They don't care, they just want more. So why do they want more? Why are they buying? Well, they want to diversify away from the dollar, they're hedging inflation, they're preparing for geopolitical risk, and they're increasing their resilience against unforeseen events in the world markets. And who's leading the purchases? Well, we know that mostly the big buyers are the emerging markets. They're countries like China, Turkey, India, Poland, and Kazakhstan, for example. And surveys are showing that around 81% of the emerging market reserve managers expect to increase their official gold reserves over the next 5 years. You can find the results of that survey on the World Gold Council website. Recently, we've seen places like China and Japan effectively reduce their exposure to government bonds, US government bonds that is, treasury bonds, as a percentage of their GDP. So as their GDP and the US's GDP has gone up, their exposure to gold has increased and the exposure to government bonds has effectively been decreasing. You may say, I've got no problem with that, doesn't affect me. But, you don't know how far this is going to go. Little by little, you find yourself more and more controlled by the state. And this is not the bad bit. I mean, obviously it's bad from one point of view for our children. But I'm going to get to the bad bit, how it affects your wallet in a minute, how it affects your wealth. So, if the wallet limits become tighter and tighter, it's conceivable that it might become harder to access your bank deposits, especially in a crisis.